Hi, everyone. This is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but I've been enjoying his work for about 6 months, give or take. It's real estate investor and libertarian Jason Hartman, and he's also the host of the very popular Creating Wealth podcast. So thank you for joining us for the first time on a Wall Street from Main Street podcast, Jason.
Hey, it's great to be here, Jason. And we got two Jasons on the show, so I hope we don't confuse the listeners too much.
But it's going to be really easy. If we forget each other's names, it's no fault but our own.
That's true.
Now, Jason, I just want to ask you some very basic beginner questions about real estate investing because our listeners are more free market oriented. They're more libertarian. They have no problems with gold and silver. But what got you interested in real estate investing?
Well, I was 16 years old, Jason, and I grew up, not desperately poor, but kind of poor on the lower end of the economic spectrum. And, I just didn't like it. I always felt like I, couldn't get what I wanted when I was a kid and, couldn't buy new clothes or go do things or whatever. And so I saw this infomercial about real estate investing, and I went out and picked up the book by the author, and I read 3 chapters of it at age 16. I put it down. My mom picked it up, read the whole thing, and started getting engaged on the real estate guru seminar circuit way back then in the 80s. And, a couple of years later, when I was about to graduate from high school, she said, "Hey, Jason, you're the one that got me interested in this real estate investing stuff. And now there's a big seminar by Disneyland in Anaheim, California." We lived in Southern California, and
I'm
she
from there.
Yeah, and she said, why don't you go? You're the one that got me interested in it. And so I gathered up 9 of my buddies from high school, and I got them to go with me because when you're that age, you can't do anything by yourself.
Yeah.
And Friday night of that seminar, I remember there was a speaker named Hal Morris, and there were some other speakers. It was a pitch fest. They were all selling their books and tapes and stuff. And I didn't know what they were talking about. I just wanted to understand. I didn't know, like he was talking about points, and I'm like, what are points? And so I remember Earl Nightingale being one of my early mentors, along with Dennis Waitley, Jim Rohn, and Zig Ziglar. And Earl Nightingale said something, he said, if you want to get rich in real estate, learn the business first. And so I figured, why don't I just learn the business? I'll go get my real estate license, and I'll learn the trade of real estate, and that will help me get into investing. So I signed up at Century 21 Real Estate School, got my license, first year of college. I was going to college and selling real estate part-time, working for Century 21, and I did pretty well at the sales. But then about 6 months after I got into the business, I had sold a little crappy one-bedroom condo in Huntington Beach to a client named Jim. And Jim came back to me 6 months later and said, "Jason, I don't like this rental property. One bedrooms, you can't get good quality tenants. Why don't you list it for me and find a buyer because I want to sell it?" And I thought, maybe this is my chance to get my first investment property at age 20. And so I actually bought it from my client. Rather than listing it for him, I bought it myself. And that's how it all started.
Very interesting. You got started at a really young age. And I guess you could learn from your mistakes. And since it's just like, investing in stocks, they teach you to start saving money aside at a young age. And you got started at a very young age. And I guess from listening to your podcast, you've committed to a life of self-education. Now, that leads to my next question. What books and courses did you take to learn how to become a good real estate investor, if you don't mind sharing a few?
Oh, my gosh. I don't know where to start. I've been to so many. I got kind of on that whole real estate circuit back in the day, in the old days, if you will. I remember Al Lowry was kind of one of the big guys. Robert Allen was one of the big guys back then. And, Russ Whitney and Tony Hoffman. And, there were a bunch of them. They were all the gurus back in the day. They're not such the gurus anymore, really. But, every time has its sort of players in it. And that was who it was back then. And I've read many books over the years. I've just been to a zillion seminars. But mostly, like anything in life, Jason, the way you learn it best is by actually doing it. And, I just started doing deals, and I can tell you about my first deal, my second deal, and how those really created the foundation and increased my interest in real estate investing. So, I don't know how deep you want me to go into that, but I'm happy to talk about whatever.
You can talk about a couple of your deals. I think our listeners would find that interesting, because my next question is, how much money does it take to get started to buy your first rental property? And that probably is part of your story.
Yeah, it is, actually. That's a very good point. So the first deal was that little one-bedroom condo on Coventry Lane in Huntington Beach. And in the beginning, it seemed like a good experience. Then in the middle, it seemed like a bad experience. Then at the end, it was a good experience. And I'll tell you how that worked out. So I buy it, and just like my client who wanted to sell it told me, I couldn't get a good quality tenant. And so I got this young couple in there. They paid rent for a few months. Then they stopped paying. And I remember, knocking on the door and having to try and collect the rent. I was managing it myself. I was all of 20. I didn't know anything. And then I had to finally evict that couple. And they left the place in a big mess. I fixed it up. And then I put it on the market, and I thought, well, this was kind of a bad experience the first time around. And another real estate investor came along and bought it from me. And I don't remember the exact numbers, Jason, but I think I made about a $30,000 profit on that little deal. And I bought it for almost no money down. It was really no money down, but I did pay the closing cost when I bought it from my client. Now, that's much harder to do today because the regulators and the government has made that a lot tougher than it used to be in the old days with due on sale clauses and so forth. But, suffice it to say, that was a pretty good deal. Then my second deal was actually a little condo in Irvine, California that I was to move into. And that was my first home away from home. And so when I moved out of Mom's house, I bought this little condo on Remington Street in Irvine, California. And I say I also did that deal with nothing down because I borrowed the down payment from my grandmother, and my grandfather put a little bit in too, but mostly my grandmother, and borrowed the money from her, and then sold it 11 months later to a friend of mine. And I put nothing down on it, bought it for $102,000, sold it for $159,000, paid grandma and grandpa back, and basically made, in essence, a 600% return on investment in less than a year. But in a way, it was really infinite because I didn't use my own money to buy it. So leverage is a phenomenally powerful tool. And real estate is the most leverage or debt-friendly asset in America.
Now, I think one hurdle or roadblock for many of our listeners, and I have paid consulting clients who I teach how to invest in stocks or, how to look for other asset classes and look for experts in those. And I think you're going to be getting some referral business your way, let's just say. But anyways, though, one of the hurdles that I hear from them is that, I don't have $100,000 or maybe they do have a couple $100,000, but they don't want to put so much of it into a rental property. And I don't think they understand that you don't need that type of money in order to get started, that maybe you only need $20,000 or $30,000 to put 20% down on a starter rental property or something like that.
Yeah.
Or you mentioned a hard money loan, and there's other ways to do it.
Right, absolutely. That's a great point, Jason. With real estate, or really we should call it income property, because that's the type of real estate we're really talking about here. And so, the nice thing is you only put about 20 to 25% in, and the bank puts 80 or 75% into the deal. So when you buy a stock, bond, or mutual fund, you put 100% down almost always. I mean, I know there are some things you can do, but basically, you put 100% down. And so here you only put 20 to 25% down. And then people would say, well, gosh, then I have to go into debt. Well, not really. Because what really goes into debt is the property. The property owes the money, and the property outsources that debt to a tenant. So I would be very debt averse if I paid my own debts, but I don't pay my own debts as a real estate investor the tenants pay the debts for me, and the property bears the burden of the debt. It's not really me, because when you look at the way a bank structures financing on a piece of real estate, almost always, not always, but almost always, the income property, the piece of real estate is the sole collateral for the debt. In other words, the vast majority of real estate loans are non-recourse loans. So they don't come after you if you don't pay. They come after the property. The property is who's in debt, not the person. Okay? And the property goes and they outsource that debt to a tenant. So that's who the real players are in the game. You're just sort of the manager of all of that as the owner.
That's very interesting, and I think that's something, it's a common misconception about real estate investing and why more people don't, buy rental properties, and people don't want to fix a toilet, or get called at 3 a.m. and have to do this or that and things like that.
Jason, that's such a great point that you make too, because like I have owned income properties for well over 20 years now, and I have never, ever, ever had a call at midnight or 2 a.m. or anything like that. Okay, now, the vast majority of my life, I managed my own properties. When I started investing nationwide about 11 years ago, I started using property managers to do that. And now I do both. Some of my properties nationwide, some that are, over 1,000 miles from where I live, I manage myself. Okay, so I do self-management and I use property managers. If I have a great property manager, I let them do it. If I don't have a great property manager, I just self-manage it. I never thought I could do that from a distance until a few years ago when one of my Texas tenants, the property manager quit. And I just I didn't get around to finding another property manager. And then about 3, maybe 4 weeks later, a check shows up in the mail with a nice note from the tenant. Hey, I hear your property manager got out of the business. Here's my rent. And so I just never hired a manager. I just managed it myself. And it went perfectly. It was a beautiful relationship. Really, you can kind of delegate. And I know this is going to sound nuts, okay? Some people are going to have some weird horror story that almost never happens, kind of like that slip and fall horror story, which never happens, it seems like, although all the lawyers use it to sell asset protection schemes, when insurance covers that kind of thing. And, I'm sure someone's going to have some weird story, but I'll tell you what. The best manager of your property is your tenant. That's who's there. That's who's going to look at things and see things. And when you're self-managing a property and it's far away, it really, in some ways, is actually easier because you can delegate some of this responsibility to the tenant. And I can give you, many examples about this, but I don't know if you want to make this about management. Really, it's more about investing. So I just want to, suffice it to say that.
Well, yeah, that's a very interesting point. And another misconception that I hear is about the residential property manager. But I mean, I have good contacts who are real estate investors like yourself, and they've had problems with bad residential property management
I have too.
But, yeah. But I guess it's something that can be dealt with, and if you know what you're doing, I guess you don't commit to the right person, or maybe you give them small responsibility and things like that. It's just like it's like investing in any asset class. If you don't do the right amount of due diligence, you're going to end up with egg on your face and money loss, and you're going to learn the lessons the painful way.
Yeah, no question about it. And that's what my company does. We help people manage their managers. We refer them to the right markets where the properties make sense to buy and hold, and then we refer them to all of the team members they need. So the property manager, every player in the game, we can provide referrals to them. But again, some property managers are great and some are terrible. This is a very fragmented business. And you know what I say on the podcast? I always say embrace the fragmentation, because that fragmentation, Jason, is what keeps the big institutional investors largely out of our business. If it were not fragmented like that, Goldman Sachs would own every property in the country, but they don't.
True.
Because it's not easy to manage a giant portfolio for them. So they're just not, they're just not set up for things like that. That's what leaves the opportunity for the small investor.
Very good point. And if I could add to your point there, I mean, BlackRock, with this cheap debt after the QE program started, you had these large private equity firms and hedge funds try to do that, what Goldman Sachs did.
They were getting out of it,
Yeah, and I guess maybe they made a little bit of money, maybe some capital gains, but they couldn't, handle the rental property side of it. They were the stories were coming out on Zero Hedge and elsewhere about how badly they were managing the property.
Yeah, I mean, think about it. If you're some Wall Street guy who wears, a $1,500 suit every day and sits in a high-rise office, right? And you run some hedge fund or some private equity group, and you can just deploy 10, 20, 30, 40, $50 million or more with the click of a mouse after getting a due diligence report. Why would you want to mess around with a bunch of $80,000 properties? They're spoiled. They're not, and it's not their money. So it's not like they're living and dying by the returns the investor makes. It's not their money. Okay.
Exactly. That's a great point. And, they're used to doing quick trades. A lot of them, they're trend traders.
Right.
A long term for them sometimes is, 1 week if they're a high frequency trader, or a month or 6 months. So, yeah. Well, let's talk about then some more of the history of real estate and investing. Let's get into some more sophisticated real estate questions. Why do you think real estate prices have gone up so much since the 1970s?
Well, I don't know that they really have gone up that much in real dollars. In nominal dollars, they have.
Good answer.
But in real dollars, real estate only slightly outperforms official inflation. It's not that great in terms of just sheer appreciation. It's a decent inflation hedge, but when it really gets awesome is when you leverage it. Because then if you think about it, if you think inflation, let's just take a real rate of inflation averaging 5%, for example. And if you put 20% down on the property, that means you have a 5-to-1 leverage ratio. So say, for example, the real estate does nothing in real dollar return from appreciation. Now, it's a multidimensional asset class, as you know, so there's more than just that buy low, sell high return concept. And we'll get to those things time permitting. But just on the sheer appreciation only, if the inflation rate is 5% and the appreciation rate is 5%, all you've done is you broke even. You're just treading water. But then when you leverage it, you multiply that because you've only got 20% in the deal, and so you're making the appreciation on 100% of the investment. So it's 5-to-1. So now your 5% turns into 25% real appreciation because of the leverage. You've outsmarted inflation by a 5-to-1 ratio. Now that's where it starts to get awesome. But there's more, as they say on the infomercial. So that's the first thing I would definitely say.
Yeah, that was a good point in terms of the nominal price increase, and I was hoping you'd talk about that, because when you look at the nominal price increase, it's increased a lot. You have these government phony capital gains taxes that people are essentially paying, where, in the 70s, in a major metropolitan area, it was the mortgage was the only thing that people were using on credit, basically. People weren't using really credit cards until maybe in the 70s or 80s. Americans, like, one of the few major debt things that they went into debt for was a mortgage, and housing prices were not super high. They were much lower than now, but I think it's a great point that, nominal price increases are really only that reason why it's gone up. But if you talk, with the Keynesians, they talk about population increases and all these other things, all these other things that the Bureau of Labor.
Yeah.
Well, now we're inflation truthers, apparently, according to Paul Krugman.
Oh my God! Yeah, it's like, here we go again. Now they're finding a way to just marginalize the people telling the truth once again.
Yeah, it's just ridiculous. I mean, they're going to keep on printing the money, and they're going to blame everything and everyone else but themselves in order to create these asset bubbles. But my next question is, politicians can change the rules anytime they want. Have any new rules been passed recently to hurt rental property owners?
Oh gosh, a lot of that is really a local issue. Most people are just paying attention to federal things like, they're looking at Dodd-Frank. They're asking themselves, what about Fannie Mae? What about Freddie Mac? Are those going to last? What about the regulations on the banks? Are they tightening the lending standards? All of this kind of stuff. But some of this is really quite a local issue as to how it really impacts a real investor. And so the thing I would say that's one of the more important things is the concept of, is the area in which you invest, or the areas in which you invest, because hopefully you're not just doing it in one. I would like to see every investor in at least 3 or at most 5 different markets, okay? So that their eggs are not all in one basket. All right. But don't over diversify. One of the mistakes I freely say that I've made is over diversifying. It's a personal mistake I've made. Okay. So I think 3 to 5 cities is enough. Okay. And I mean 3 to 5 metropolitan areas. I don't mean, one city right next to each other. That's not diversification, metropolitan areas. So the reason these rules, as you asked, matter is that if you're in a landlord unfriendly market, for example, the Socialist Republic of California, the Socialist Republic of Washington, D.C., the Socialist Republic of New York, any place that is landlord unfriendly and is tenant friendly, those are places you really want to avoid, because if you have a tenant go bad, if you have a tenant problem, you just find that you have no rights. The law does not care about you, the big evil landowner. Your poor little tenant, you've taken advantage of them, and all landlords are evil, and capitalism is evil. These, some of these activist judges are literally nuts. Okay. And, you try to do business in San Francisco or Santa Monica or New York City, you just got to have your head examined. Not only do the numbers not work, but the courts don't work either,
And then there's a lot of rent control in some of these cities too, right? Where you can't reinvest in the property and raise the rent price like in a free market. You could. Yeah. It just doesn't. The incentives are all screwed up.
The incentives are all screwed up, and Jason, all of these idiotic socialist government programs ever turn out to do is they never help the people they promise to help. Rent control's supposed to help the needy in these expensive cities, right? You know who it really helps? It helps these frickin' celebrities, people with connections, people that act in the gray market, okay, and do underhanded deals. And you know what else it does? It gives the landlords an incentive to want to make life miserable for their tenants, so their tenants will move. Because as soon as those tenants get out of there, they can adjust the rents to closer to a market rate. But, people in these rent-controlled apartments, they stay there forever. Why would they ever let them go? One of our contractors lives in San Francisco, and, he does some video work for us, and I swear, Jason, I'm going to put him on my podcast because his story will blow your mind. It goes something like this. He's lived in his rent-controlled apartment with a stunning location in San Francisco for something like 21 years. And I was just talking to him about this, and he pays like $2,000 a month. The place is worth about $1 million, okay? Which is, by the way, the median price in San Francisco now, $1 million, if you can believe that. And there's just, it totally slows the velocity of money. People that live in places like that, they're not out looking for new homes. They're not out looking to stimulate the economy by buying up. They just want to stay put forever. It causes a stagnant population. It's a terrible idea in every way.
Yeah, I mean, the incentives are screwed up, and the thing about the velocity of money, anyway, that's a Keynesian creation, and GDP is a Keynesian creation in terms of, government spending is counted as a bonus in there. So, I mean, there's just so many perverse things wrong that the Keynesian central planners and a lot of these Marxist progressives have put into society that people don't even question anymore. And most people are just content with dealing with the status quo, and as long as your friend can get like an undervalued rent, I don't think he's going to care that much. But when the rules change, and the rules are probably going to change, because I think none of the stuff that we're seeing in the economy right now, or a lot of it, is not sustainable. And the rules changes are going to hurt people like that, because they're not going to be resilient and be able to adapt.
Yeah, absolutely. You're absolutely right.
Now, let's talk about the shadow inventory here in the U.S. Does that affect, I don't know what your opinion is on the shadow inventory, if you think there's still a lot of it or not in major urban cities, but does that affect a rental property owner, or you're not really worried about that much?
Well, it certainly matters. And if I told you I knew what the shadow inventory was, or if anybody told you that, they'd be lying, because the answer is nobody really knows. Okay? They really don't. I don't think it's that big a deal. It matters, and it's important to know, but a lot of it has been gobbled up. A lot of the stuff that we saw, and this is a good comparison, because as we were in the darkest days of the last economic crisis, okay, and I believe that this recovery is largely fake. Okay, so you're not.
Me too.
I'm not an optimist. I'm just an opportunist. Okay, I'm just an evil opportunist. That's all. Okay, so hate me if you wish, but that's all any of us can do is control our own lives and our own situation. We are in the position where all we can do is react to government and central banks and play within their game. And I say, do what they're doing. They're investing and running their business, the business of government, for inflation. And, basically copy them, and we can dive into that more later. But on your shadow inventory question, the important thing to remember is that income property is a multi-dimensional asset class. And as such, we can always make adjustments within those multiple dimensions of the investment. So, for example, if say there's this giant shadow inventory out there, say there's 10 million homes in shadow inventory that one day the banks are just going to release onto the market, and it's going to flood the market, and it's going to depress prices. Well, that certainly could happen, and that's one of the things that people have said, that the banks aren't releasing that inventory because it would suppress prices. Now, that talk has largely gone away because we know for sure a lot of the shadow inventory has definitely been gobbled up from the darkest days of the Great Recession. Okay, but some of it still exists, and we don't really know what it is. And the reason the stats are never right on this stuff, Jason, is because you can never know how much of it will be worked out before it ever makes it to a foreclosure. So if we look at properties in the pre-foreclosure phase where the loans are in default, but the lenders are working with those borrowers, and they might modify those loans, they might do short sales or various forms of workouts on them, well, then those properties never really become shadow inventory, right?
Yeah.
And so
that's a good point.
So that's one thing. A lot of those work out in advance, and they never hit the market as shadow inventory. And the other thing about it is that if we were to see a bunch of properties flood the market, well, what would be the availability of financing? Would it be low interest rates but hard to qualify for? That's the environment we find ourselves in now. Or would it be high interest rates to stave off an inflationary threat? And that would mean that people can't buy because the rates are too high. Either they can't buy because they can't qualify, or they can't buy because the rates are too high. And if we have that, all that does is put upward pressure on rents. So there's always an adjustment that you can make. When you own income property, you're in the position of thinking, okay, right now the game is capital appreciation, or no, it's not. If the market is down, usually there's upward pressure on rents, because those are usually contrary indicators. And when there's upward pressure on rents, then the strategy is sit back, increase your rents whenever you can, and just wait. and hold your properties for cash flow. So you just have to adjust the mindset for that multidimensional concept.
It's a good explanation, and it seems like there is upward pressure on rents. I live outside the Washington, D.C. metro area, and rent is quite high in this area, and we have listeners from all over the country. Their rents, like in L.A. and New York City and major metro areas, are very high. It's taking up most, if not all, of their paycheck. And, if I could add to your point there about, like, the shadow inventory, from what I've heard, at least here in the D.C. metro area, because, most real estate is local, right? I have good contacts who are real estate agents in this area. In fact, I know one of the top selling ones in the D.C. metro area. And there's a lot of foreigners who come in here, all cash, people from Europe, from Asia, from China, people here who think their country is more dangerous or more politically unstable, or inflation's even worse than here in the United States. Because, maybe Japan or China did more quantitative easing programs than even the United States did the last couple of years, and they want to diversify into these markets because it's perceived that these markets are safer.
Right. Yeah, absolutely. And you know what, Jason? That is a great sign that bodes really well for America, that we are still thought of by the rest of the world, maybe not ourselves, but by the rest of the world as the Brinks truck of the world, because still FDI, foreign direct investment, is just flooding into this country. I mean, Ukrainians and Russians. I just interviewed a big-time broker from New York City about 3 weeks ago on my show, and you just cannot believe the amount of money flooding in to some of these markets. The South Americans buy Miami and South Florida. The Europeans they all buy it all. But there's just, you see foreign investors everywhere. I mean, we see them buying up Indianapolis. Talk about like an unsexy non-flagship market, right? We have clients from all over the world that are buying properties in Memphis, Houston, Atlanta, Indianapolis, wherever. It's just everywhere.
Yeah, I think it's very interesting that people just don't understand exactly how much global quantitative easing has been printed. It's not just the U.S. printing money. It's, the China with the dollar peg, the Chinese central bank. Japan has been printing. That's created. I did a podcast recently answering a listener question about the yen carry trade. I think the yen carry trade has created enormous asset bubbles globally for the last couple decades. And, it's just so many other countries that are all printing, and people are not going to hold the money.
Yeah.
It's not going to stay in the bank account, Jason. It's going to go into one asset, whether it's going to go into precious metals, gold or silver, or it's going to go into rental, probably rental. A lot of it's going to go into rental property because people want cash flow, and people have been taught, conventional Warren Buffett type of finance, where they tend to view, dividend cash flow or rental property cash flow as better than holding physical precious metals.
Yeah. Well, money doesn't sit still for very long. It's not a very calm thing. Money wants to go somewhere, and it wants to do something. It wants to work, and that's, or it wants to spend, and those are all good things, I guess, especially on the spending side if you're Keynesian.
Yeah, and eventually, people already realize there's inflation, and if you talk with a lot of foreigners, they know that their government's own inflation statistics are bogus. Most Americans tend to not believe their government statistics are bogus, especially ones that went to, conventional business schools that were taught Keynesian economics. They see deflation as this evil boogeyman, and, they say we have to fight deflation at all costs. But, if you've done the right thing and you don't have that much debt, or maybe you just have rental properties and, you're not using debt for consumption, it doesn't seem to me like debt's not, or going into debt is not a bad thing. Well, excuse me then. Well, if you don't have that much debt, it's not a bad thing. Whereas the Keynesians then are, they want everyone in debt. They want, people, student loans. They want subprime auto loans. They just want to grow the credit, in limited amounts. Have you seen the new Chris Martinson crash course out?
There's a new one?
Yeah, he just did an accelerated new one he just released, and he's been releasing his updated one chapter by chapter. But he showed that the credit growth creation of the United States, so the money supply and the credit are perfect exponential functions, and the only way that can exist is a fraud. So, so it's just interesting. They're trying to get the only time I believe credit really contracted, right? And we had a credit contraction was 2008, and that was on a long-term chart. It was just a little blip.
Yeah, yeah. I think the area that people get into a lot of wrong thinking about the economy and about the U.S. and about government spending and government debt. The area where people sort of go wrong is, and I've said this on my show. You already probably know what I'm going to say here. Is that they just do math. They just do math only, and they think, oh gosh, there's got to be massive inflation. The U.S. must lose the reserve currency status and all of this stuff because of the math. We're massively in debt. We got 17 trillion, plus we've got, anywhere between 60 and 200 trillion in unfunded mandates coming our way in the next 2 decades. And, we've got this and that problem and all of this stuff. And you know what? If you just do math, you're absolutely right. It's true. We should have hyperinflation. We should lose reserve currency status. The world will say, F you, we're not taking your dollars or your treasury bills anymore. We want to be paid in gold or rubles or something else, whatever it is, right? And but the dollar is not the thing. But the thing they don't realize is that America has some very special circumstances. I know the famous line of every person who's about to get like creamed in investment, Jason, they say this. They say, this time it's different.
Yep.
But it really is different, okay, with this situation. No country, if you look at all the past big examples of hyperinflation and, economies that have been destroyed, none of them had the reserve currency. None of them had the world's largest military. None of them had the world's biggest brand. And none of them had really still a relatively free rule of law country with good infrastructure. Okay, granted, we can argue that point too. But by and large, America is still pretty awesome. Okay, even as messed up as it is. So.
Yeah, I'm just hoping to reform it. I mean, I haven't decided that I'm completely leaving and never coming back and giving up my citizenship yet. I know some of our listeners on our podcast have made up their mind to do that, but I haven't. I think America can still come back. We still have Silicon Valley. We have the shale oil entrepreneurs who have managed to defy a lot of people, the regular peak oil people saying, U.S. can never grow oil production again and things like that, and they've done it. Now, I don't know how long the shale oil boom could last, but they managed to do it at least for a number of years, and that's that along with how the world financial system is designed. I mean, the people who are calling for hyperinflation immediately, they didn't understand that there was no other system prior to the bilateral trade agreements that had been established really after 2008. They were calling for hyperinflation prior to that, but there was no other system in place to get away from the dollar. So there had to be all these bilateral trade agreements set up in place. So they were way ahead of the curve on that, just doing the math like you said. But they didn't understand that we're essentially on a dollar standard right now. I mean, I've pieced this together from reading hundreds of other experts, Jim Rickards' books, many others.
Jim Rickards is awesome.
Yeah. Yeah, Currency War is great, and his new book is great. I've interviewed him too. And in terms of like the way the system is designed, we're on a dollar standard, and the other countries are basically importing the inflation the U.S. exports. So we ship them dollars. They work their butts off to produce us, Toyota cars and Mercedes-Benzes and all these, all these goods from China, and all they're getting in exchange, mostly, they're not getting a lot of goods and services. The U.S. is producing, they're just getting dollars. So so it's not a sustainable system, clearly, where you're not trading goods for goods. But, it's tough to say when the thing will exactly end. And they've kept the politicians and the central bankers and, the people at the IMF and the World Bank and the Bank of International Settlements, they've all coordinated. The global central bankers, by the way, Jason, are working together. I mean, the Japanese yen, the Japanese yen should have collapsed already. Sure. There's so many currency swaps and backdoor bailouts behind closed doors that we may never find out about. That's why the currency markets are looking so unvolatile right now, when they should be, extremely volatile.
Yeah, absolutely. So, you're absolutely right. Yeah. It's just amazing. The whole thing is a total Ponzi scheme. Okay. It's disgusting. But the fact is, it is what it is. And all we can do as individuals is just react to it. And, there are it brings about, as disgusting as it all is, it brings about some awesome opportunities for investors because, a lot of my investment strategy is built around inflation. Now, if inflation doesn't happen, and say, for example, we keep kicking the can down the road and we defy gravity for decades to come, and we only have moderate inflation, where the government tells us it's 2 or 3%. In reality, it's 6 or 8%, but it's still fairly moderate. Okay, it's not 25% or 100% or 1,000% per month, like some of the historical crazy examples out there. But say we only have that. Okay, income property is still the right investment because in that deflationary or moderate,
I call it stagflation.
Yeah, stagflation type environment, Phillips curve, whatever you want to call it, right? If we have that, then the investor thinks, where do I get yield? I've got to get yield somewhere. I can't get it in the bank account. I probably can't get it in the stock market. I certainly can't get it in bonds. Okay, all you can do is really income property. You're not going to get it in the metals then. And the metals don't produce income, and they don't have tax advantages. So that's some of the problem with the metals.
Well, they intentionally don't have tax advantages because the government doesn't want people going to the metals.
Of course they don't. And not only that, it gets worse. The central banks who are in cahoots with governments manipulate the prices down they suppress the prices of gold and silver. I'm sure you know about GATA and the Gold Antitrust Action Committee. So, anything that is the enemy of the most powerful system that has ever been devised by humanity, and that is the central banking system, and layer that in with governments, with militaries. If you go against that, it's just, you're not likely to win. Okay, they have so much power. That's why I'm not a Bitcoin fan. I'd love to be wrong about Bitcoin. I'd love to see that succeed. And, I'd love to see people turn away from the dollar and every other stupid fiat currency. But, they can just squash that. They're too powerful.
Well, I don't know if they can completely squash Bitcoin, but they can make it really tough for people to do transactions or to invest in Bitcoin. Like I think with the IRS tax purposes they've already made it where you have to track every single transaction where you buy and sell Bitcoin. So if you pay in Bitcoin at the movie theater or pay in Bitcoin for a restaurant, you're going to have to deduct capital gains from that. It's going to become a huge hassle unless some entrepreneur can solve that and get around the government laws. But the way Bitcoin.
Yeah, go ahead. Sorry.
Yeah, the way Bitcoin was designed, though, it's kind of I heard this analogy on a Milken Institute discussion, which is kind of sponsored by government bureaucrats and planners and stuff. But basically, the entrepreneur said, the government can't shut down the freeway; they can only make the on ramps and the off ramps harder. So, but, the entrepreneurs are going to figure out ways around it, and I think, like we said before the recording, Silicon Valley has just invested so much money into Bitcoin, and Silicon Valley has a lot of pull in DC and on Wall Street because they're the real creators of wealth. Unlike, the people on Wall Street and on DC, they're not rent seekers. The people in Silicon Valley are actually generating value. They're solving people's problems. They're creating, the iPhone and the iPad and all these amazing products and apps and things like that. So their word carries a lot of weight there. It'll be interesting to see how things play out. Bitcoin may be given an easier chance to grow and develop more than gold and silver, unfortunately, because, the Keynesians just really hate gold and silver. I don't know if all of them fully understand Bitcoin yet, or they don't think it's that much of a threat yet compared to gold and silver. Okay,
so I really like that analogy you just made of the freeway. They can't shut down the freeway, but they can shut down the on and off ramps. I don't know, though. With cryptocurrencies like Bitcoin or whichever one you pick, Kanye coin, whatever. Kanye West has a coin too, whichever one you pick. I think maybe they can shut down the whole freeway. How legal is it for you and I, if we want to make a trade, Jason? Can we trade in cocaine or heroin?
Nope. See,
they just make it illegal. They can just make it illegal. And of course it will be for our own protection. It always is. Because they might even engineer some scam or calamity or just make a big deal out of some that are out there, like these Bitcoin exchanges and those frauds. I don't know, but they can. The government is omnipotent, man. They can do anything, you know.
They are, but their early patterns so far, initially, they were against it, and you are seeing the World Bank come out against Bitcoin, but you're seeing California politicians, start to legalize Bitcoin, I think, for transactions, and New York ones are not far behind, but those are just in the key hubs of Wall Street and Silicon Valley. Well, it'll be interesting to see if they reverse course and change that, but, obviously there's a lot of political pressure on them because Silicon Valley just invested many billions into Bitcoin development. There, in fact, almost all the best computer programmers, Jason, that were working on other things like apps and biotech and stuff, almost all of them have gone into Bitcoin recently.
Yeah.
So it'll be really interesting. I mean, it's a battle. It's a cat and mouse game. So we'll just have to see. But I mean, I'm all for competing currencies. So I would like to see the debt-based fiat currency, go to zero, and I'd like to see the market, figure out which one's better for which transaction. So maybe it's using silver or silver certificates for small purchases, or Bitcoin is fine too, and then gold for large purchases, or like a gold-backed virtual currency, or gold certificates or things like that. But unfortunately, as long as Wall Street and DC can continue to borrow near zero and create asset price inflation and things like this, I don't think they're going to go willingly. So I think the more people that we wake up on our podcast and educate, what money really is, and I think that's also an important question with Bitcoin, is people who are not libertarians, who are not gold or silver bugs. They're starting to ask now because, maybe they've been tech savvy their whole life. They're starting to ask, well, why is Bitcoin better than the dollar? And then they get into some of these questions that we've been reading about for a while.
Mm-hmm. Yeah. Well, listen, like I said, I hope I'm wrong about this. I'd love nothing more. I own exactly one Bitcoin. Okay, that's how many I have. I just wanted to try it, use it, and see how it worked, and buy things with it. And so it's interesting, but I hope I'm wrong about it. I would love nothing more than to see alternatives to fiat currencies.
Yeah, I agree. Well, in wrapping up this interview, Jason, please tell our listeners where they can find your work, your podcast, and also if they want to contact you for helping them get a rental property.
Yeah, thank you so much, Jason. I'm at jasonhartman.com. That's JASONHARTMAN.com. And you can find my Creating Wealth podcast on iTunes. It's one of the top-ranked personal finance and investing podcasts on iTunes, or on Stitcher Radio. And just type Jason Hartman in the iTunes store or at Stitcher, and you'll find it, or directly on my website at jasonhartman.com.
Well, thanks again for your time, and hopefully I'll have you back on again soon.
All right. Happy investing to you and your listeners, Jason.